Welcome friends. Today we'll discuss about CRR, cash reserve ratio. As you might be aware, tomorrow is RBI policy review and you will come across the word CRR, SLR, repo rate, reverse repo rate, all this terminology tomorrow. So I thought it is pertinent to discuss those financial jargons and simplify, dissect those financial jargons so that it would be easy to you to understand and have meaning for yourself and you can use them as per your liking. Friends, if you have any question regarding this, you can put in comment box or any other topic you want to be covered, you can put here in comment box so that I will try to answer today or else definitely in next live session I will answer those questions. So first is CRR, cash reserve ratio. CRR is abbreviation of cash reserve ratio and it is RBI mandate to fix CRR and other SLR and reverse repo rate, all these ratios for banks to regulate the Indian economy, especially this monetary policy is under RBI, Reserve Bank of India. And it has been designed to satisfy, or we can say, liquidity in the economy, Indian economy. So, how it happens, how this is controlled. Once RBI increases the CRR ratio, this will suck liquidity from banks or cash from banks, and that way it is liquidity in the economy is reduced. Actually, CRR or cash reserve ratio is the ratio banks are mandated to deposit in RBI in cash form. Suppose bank got 100 rupees of cash as a deposit. If RBI have 10% of CRR ratio, fixed ratio for banks, then bank will have to deposit rupees 10 with RBI and balance 90 they can lend again once lended to customer will not have cash, definitely they will deposit with their bank and use from there. Again other bank got 90, they can maximum 81 rupees can lend, but 9 rupees they have to keep with RBI. So like this amount will reduce and this 100 rupees can be circulated to 1000 like this. If you will add 90 plus 81 like this will slowly it will reach to this. So from here you can understand if this ratio is increased then there will be less money with bank to lend. If the ratio reduced, for example, in place of 10, if it is 5%, then bank will have rupees 95 to lend. Then liquidity in the market will increase. So bank sees the condition of economy, country economy, inflation, and so many factors, and decided to increase or decrease as per requirement, so that neither inflation increase nor market hit up too much. To balance, keep the balance between growth and inflation, RBI have so many tools. One of them is CRR, cash reserve ratio. Whenever RBI wants to reduce cash, to have less cash in the economy, less liquidity in the economy, then it will increase the cash reserve ratio. And this will reduce the cash in the market. So, what will ultimately happen? It will reduce consumption and growth, and it affects inflation. To reduce inflation, RBI increases this because it is also important. If inflation is increasing more and more, then it can be a blast. So, RBI needs to have balance between growth and inflation. Another term is SLR, statutory liquidity ratio, and every bank have to maintain this is obligation with bank to maintain that much ratio with themselves. Bank maintains itself. Whereas in the case of CRR or cash reserve ratio, bank are mandated to deposit those cash with RBI. But in case of SLR, bank maintain with themselves or commercial banks in the form of either cash, gold, or government securities. Government approved securities they can have. Right now, in India, CRR or cash reserve ratio is 4.5%, whereas SLR, statutory liquidity ratio, is 18%. There is difference between CRR and SLR. First we see CRR and parallelly we see SLR. So CRR is percentage of money that banks has to keep with RBI in the cash, whereas SLR is the percentage of money, cash, gold, or even government approved securities with commercial banks or with themselves. From here, you can clearly understand. In the case of CRR, it must be in the form of cash only. But in case of SLR, it can be either in the form of cash, gold, or government approved securities. Now we see the difference of usages. RBI uses these tools, CRR tools, to regulate the flow of money within economy. RBI ensures SLR for the solvency of bank. If bank have SLR limit, then there will not be any insolvency problem, and whatever the withdrawal requirement they can fulfill easily. Of course, third is reserves where can be kept. CRR kept with RBI only and SLR kept with commercial banks. What will be impact of this? As earlier said, CRR impact will be it regulates the liquidity of the cash in the country. SLR maintains the growth of the country, credit growth of the country. So these are the minor differences between these two. Now I think you would have clearly understood CRR and SLR, or cash reserve ratio and statutory, st- statutory liquidity ratio. Tomorrow we'll see another some financial jargons. Keep them, keep watching, and if you have any question, keep posting. If you find some value, please do comment and share with friends and colleagues so that they can also get some benefit out of this. Thank you. Bye bye.